So, good morning, active traders, and welcome to SwingScans.com. I'm Ken Calhoun, your host, president of Trade Mastery, with another exciting, action-packed episode. You saw how well mostly all of our alerts worked out last week. Let's see if we can continue on in our current market environment. As always, all information is for educational use only, not making advice about what to buy, sell, or hold. You can upgrade to monthly to annual if you want to give that some thought. We've got a really good plan available for you. You can save a lot of money if you upgrade from monthly to annual. You can contact me for help with that. This week we're going to start off with how to avoid false breakouts, part 3. And one of the first tips I want you to think about is to really stay away from what I call pop and drop charts. And you may have seen those elsewhere. Those are charts that are especially volatile and they run up and down. And they're really difficult to trade because they sharply run up and they spike and then they just enough to get people in and then they go against you. So that's why here at SwingScans we like consistent trends. We also want to follow what I call acceleration ramps, and that's a steady uptrend of several days, 3 to 5 days in a row of a steady slow trend that then starts to hockey stick into a 45-degree angle momentum breakout with high volume, and those make for some of the very best plays. They'll often gap in your favor and the rest of it. And then also look for consistent uptrends like the ones we follow here. Let's start off by taking a look at our S&P. You can see it has been running up here nicely. The resistance area we're using, last week I said we go long over 27.52. That was a successful, correctly called market alert. This is the S&P 90-day chart. Our R1 level is up at 27.88 this upcoming week ahead. So we want to go long. If the market gets over 27.88, the sell trigger or the support trigger is 27.34. So with that as our market, this is the 15-day chart. Let's take a look at some spectacular charts that are beating the market and where they make sense to look at for entries. First one up to bat, LL. This is a perfect example of an acceleration ramp. Do all of you see just how good this chart is? It's got a good steady acceleration ramp. There is no special black box indicator for that. It's just your eyes, right? Intelligently look for a steady uptrend that then hockey sticks into a sharper angle breakout. So I've trained so many thousands of traders and published in the magazines and all the rest of it. Really nice explosive high volume close on the market yesterday, and you can see the trading range, and this guy is spectacular, from 20 up to 25. So it's got a 5-point range on a $20 stock. That's another key tip strategically to look for, is wide range point charts. See, this chart would not be any good if it only had, say, 20 to 21 as the range, even with the same exact chart pattern. It's the point range that makes it all worthwhile, because from your profitability standpoint, you always want to ask yourself as a trader, how much money can I make in the chart? And it's got to be multiple points, right? So we want charts that start off hot with nice wide trading ranges and combined with a consistent high velocity breakout pattern like this guy. So this is LL, the ticker. Next up, we start off by looking at these 15-day charts, then we go back and take a second look at the 90-day charts to look for longer term trends and help determine initial risk management size. Oh, hey Barry and Mukesh, how y'all doing? So this one is PHM, and this one is good because mostly the Wednesday through Friday breakout had been a congestion box. Trader had asked about box trading ranges earlier. Previous resistance becomes new support. We're off to the races, and I like the strength, the directional volatility of this chart. So the volume is really high. The 15-day high volume into the close yesterday, which is always a good thing. May even gap up on Monday or Tuesday. But anyway, it's got a good directional bias to the upside and really good relative strength from a breakout trading standpoint. I always want to give preference to charts like this that have recent buying pressure. Next up, UA has an even more consistent uptrend, a nice big swoop going from 17.80 up to 22. So over 4 points, almost 5 points of range on this chart makes it a winner. I always ask myself, and something that you may find helpful in your own swing trading is, how much money could I have made with this chart using the techniques, that I teach, and how could you make new trades on the upper right side of the chart if it does take out new highs. So we got a kind of a flag pattern up here, or a box trading range right here from 2140 to 22.6 that followed a big uptrend. And oftentimes this rest or pullback to support is healthy. It's kind of breathing room. The thing did a big swoop up, either pulled back or went sideways a little bit, and then oftentimes they'll continue the next push upwards, and so that's what we're ready for. So we'll see if Under Armour continues on up. It's got a nice breakout volatile pattern to work with. Good directional bias. Also visually, you also want to give preference to charts that have narrow, clean patterns like this with tight channels without major pullbacks. Next up, a really spectacular breakout in Valiant Pharmaceuticals, VRX, the ticker. You can see this guy broke out over resistance back on Tuesday, and it ran all the way from 22 whole number up to 23.5. So 1.5 range, did a nice gap up here. Got a lot of bullish things going on in this chart that I like. And as a trader, as an active trader, you're always looking for which charts give you an edge, which charts give you a distinct advantage compared to other charts out there that you could choose, and how do you make a trading plan based on 5, 6, 7, 8 of the charts. You see, I carried over I believe it's four of the alerts from previous week to our current week with new triggers because they worked out so well. And those are the kind of charts you're going to focus your energy on here as a SwingScans member, is not only the initial triggers with charts that are spectacular, with amazing strength, but how do you position size or scale every couple of points? Remember, in the members area, under the alerts table that gives you the specific entry triggers to work with, there's rules for how to manage stops, how to handle gaps, how to set re-entries, how to scale in, to add to winning trades, and the rest of it. So a lot of good and a cliff notes there under the main alerts box. Remember, we don't go long until it breaks over resistance. I had a trader ask me about, I think it was, it wasn't the SEAS, it was another chart, but it hadn't even hit the entry trigger yet. So just because it's on this list does not mean we go long yet. We wait for it to break above the specific trigger that is set in the members area, and that's set there on purpose to avoid, the goal is to avoid false breakouts, keep you guys out of trouble. So we would never buy, say, if Monday morning opens at 26.10, that would be a horrible place to buy. Instead, you want to use the specific trigger that's provided for you in your members area, and that builds in my expertise for avoiding false breakouts. So you kind of park a safety buffer or a price action window of 20, 30, 40, 50 cents, something above the high, based on the volatility of the pattern and all these other factors I use to keep us out of the false breakout and in on the one that actually keeps running up. Also, if something runs up, another quick trade management tip, if something runs up, say, 2 points in your favor and you're in a profitable trade, you may want to either add to the trade to scale in or position size, or if you're a newer trader, you may want to scale some of it out and take profit. So if this guy runs up to, say, 28 or 29, you may want to just sell it all and take early profits. So something runs kind of 2 points is kind of my decision-making criteria for charts, mostly these in the $20, $30, $40 share range. If a chart runs 2 points in your favor and then starts to fade back down, sell it all. There's no reason to stick around, right? If it runs up over 2 points, like 2.5, 3 points, you may want to add to the trade to leverage in. But that's why you want to experiment with so many of the different alerts that I provide for you intelligently here. Is I give you great directional volatility breakout plays, spectacular breakout charts to work with, but the trade management side of the equation is even more important. And what you want to do is test out different techniques. So if something runs a couple of points, maybe that's a strategy you test out for the month of June and July, is 2-point winners. Okay, a 2-point winner technique would be, if you buy wherever the trigger is, maybe 26, I don't know offhand where I put it, 26.5 or something. If it runs up to 28.5, you might want to sell it all at that point, right? So, and every time you have a breakout swing trade that runs 2 points or more, or at least, like I put in the members area, tighten in a trailing stop every 1.5 or 2. So anyway, trade management tips. Do give that some thought. That's important. Anyway, that's a great chart, VRX. Next up to bat, CTRP. This is a bullish cup breakout. See, there's a cup pattern. It's not an inverse head and shoulders, but it is a cup and a handle, right? Like a coffee cup. You've got a cup and a small handle breakout. So Wednesday was hot, Thursday not so much. Friday's trying to pick up some heat. Remember, another quick tip is we don't buy anything with a 9 in it. So that's why the long trigger for this in the members area is over 50. Because often you get false breakouts or chop there. So maybe it takes, not next week, but the week after, maybe it breaks over 50. Maybe it runs up there Tuesday. We don't know. But do look for these kind of patterns. You got good relative strength. And avoid 9s. So this is a great looking breakout, but it may fake out somewhere between 49 and 50. So that, in case you're a new member and you're wondering, why isn't your trigger 49.5 or something? It's because I often find, as I publish in Stocks and Commodities magazine, it was validated by one of the world's top experts using some back testing and all that. He found out that sure enough, the don't buy 9s rule of thumb works out more often than not. That's a good strategy. So we don't want to buy right now, but if it breaks over 50, it's worth a shot. But it's a good chart. It's a good breakout. CTRP. I try and build in all these professional swing trading tips and coaching techniques for you in each of our broadcasts. That's one of the reasons SwingScans is one of the world's most popular swing trading services, and it's my #1 bestseller. So thank you for all being here. And thanks to all of you who are new members for giving it a shot. You saw how well the alerts worked last week. Let's see if we can carry on with new breakouts that work out as we have for years here exclusively at SwingScans. This is my handy dandy acceleration ramp pattern again. You got a steady uptrend, hockey sticks into a sharp angle breakout in Mattel, MAT. That was the first stock I ever bought in my life back when I was a teenager. It was MAT because I thought it was cool you could buy toy company stocks. But anyway, Mattel looks like no toy here. It's gone from just around 15 or so up to 17. So it's got a nice healthy 2-point run to it. It's got a steady uptrend continuation and a nice big, it's awake, it's alive, it's alive, bzz, it's alive run Wednesday, Thursday, Friday. So stop the madness. We've got to see if it keeps running, but it's starting to swoop up to new highs here, so that makes sense. And yeah, do feel free to post questions. I will stick around and answer questions afterwards, as I always do and have for many, many years now. But that's a good chart, right? If you do trade a chart that's a under $20 stock, especially, this type of consistent pattern makes sense. And as a trader, isn't that so important, so valuable to your own trading approach, that you look for consistency in the charts to help build consistency in your trading? You know, if you want consistency in your trades, you need to start off with charts that have consistent directional bias and consistent trends. That's what I spend my life finding for you guys, the world's traders, is best charts with consistent patterns, not the pop and drop dangerous charts. So that's a good one. So that's MAT. Again, experiment with the rules that I have in the members area. You may want to test out 3 points or 1 point. My rules are just a starting place for your own intelligent thinking and working on things your own. The trade management rules are not written in stone. They're the ones that I like to use in my own trades, but your mileage might vary depending on how much time you have to allocate to watching your charts and whatnot. So you may want to use, say, looser or wider entries and stops if you have less time to watch the market. If you're in front of the charts as much as I am, I like to keep things tight. And so my approach as a trader is, because I have so many thousands of customers and so many dozens of charts I trade, I like to use a relatively tight approach in my charts. But you may want to test out different levels. You should do that. You should test out. These charts are all great places to get started with, but you want to ultimately get to a point where you coach yourself and you're developing your own trade management rules in a way that makes sense and serves you well. Okay? You can't trade, like a spreadsheet. You got to trade reactively and adaptively, and make sure that you've got a good, intelligent, specific, rules-based approach that you follow depending on the strength of the stock market, the strength of the chart you're trading, the volatility of the chart you're trading, and your own personal risk tolerance. And you got to develop your own trading approach. Thinking person's trader, you always want to figure out something with testing that works out for you. Anyway, this is the next one, PTCT. This guy ran from a base of 30 up to 37. Really good volatility, 30 to 37 and a half. Got over 7 points of range. That's over 20% range on a $30 stock. That's good. It did a breakout, a consolidation right now, starting to break out a little bit yesterday. We'll see if PTCT continues to skyrocket on up to new highs for you, but that's a good chart. Next up, this one's been good for both day and swing trading. Momo, gap continuation runner, gap to 43. It's now at 53, just under 53, so a 10-point run in Momo. One thing to be on the lookout for visually, always the devil's in the details, right? You're always looking for, what was that great movie with, I think it was, I forgot it, with Keanu Reeves and Andy Garcia, I think. Or no, it was Al Pacino. It was a great movie about the supernatural and the devil and all that. Anyway, devil in details. The point is, you got multiple gaps here. And be on the lookout as a trader for any chart. And refer back to my technical analysis of Stocks and Commodities magazine article, if you're a subscriber, to multi-gap continuations. But that's a really good pattern. It's kind of the basing for a breakout, an explosive, high-velocity breakout. If you see one gap, and then a day or two or three later you see another small gap, then a day or two later you see another gap, that means the traders are so excited to get into that position, they're willing to pay out of market to get into it, because they know something you and I both don't know, right? There's so much stuff going on Wall Street, they hear stuff, right? And there's a reason why they gapped it up 3 days almost in a row, 3 out of 4 days in a row. You got a big gap here, then an itty-bitty gap here, and another gap here, and that led to a nice breakout. So triple gap play, and it's off to the races. Those are the kind of price action trading setups that you'll be learning about here. Continuing on, all of you as SwingScans members, I always like to focus on professional price action breakout strategies that have high volatility, and the main benefit here is learning how to trade. Yeah, the specific charts and the alerts are all in service of that education, but the main thing I want you to learn is a discerning, intelligent trader's approach, like a former corporate statistician and quality engineer that I am, an intelligent approach that makes sense to trading charts that are actually worth taking a shot at, right? You don't see any squiggly lines, you don't see any proprietary indicators. Buy my special scanning indicator for only $100 a month, or $200 or $2,000 lifetime license, and you too can magically see green arrows and red arrows light up on. Really? As my daughter would say, really? No. You don't need red arrows and green arrows and all that crap. All you need is a brain. Like in The Wizard of Oz. And hopefully I'll give you the brain power with the charts that make sense. And that's the good news. All you need is your brain and 2 eyes, and you don't even need your ears, but 2 eyes and a critical analysis capability to take a look at the intelligence of the charts and how well they work. Fossil, one of our earlier picks, continues to skyrocket on up. So I want to teach you how to become good professional price action breakout traders. That's my whole big goal of SwingScans. The alerts and the charts are all in service of that, but my goal is to really help you become more successful at this with no BS, honest, correct, intelligent, professional, step-by-step training. And thanks to all you who've been here with me for years. There's a lot of you now have been with me for quite a few years. Many of you are celebrating your 3rd and 4th year with me. Many of you are brand new. We've got traders from all over the world here. These are also really good for those of your options traders. You know, if you want to sell puts or buy calls or do iron condors or butterflies or diagonals or spread trading or whatever, you can use these because they're exceptionally good pre-existing directional volatility charts. If you look at your Greeks and all the rest of it on these, you'll see what I'm talking about. Anyway, Fossil, a nice gap up continuation. A little gap here, ran up, did kind of a bullish flag pattern, continue to run on up. It makes sense to look at up in new highs. That's FOSL. Really good range too on this guy from 20 to 28. It's got an 8-point trading range on a $20 stock with a consistent trend. What you don't want, and my tip earlier about avoiding pop and drop, is charts that aren't the ones I cover but other people look at, where maybe you have an 8-point range but it did a skyrocket up and came right back down again. That's no good. What you want is something that built honestly a good 8-point range. It honestly built with consistent price action overall, day after day and week after week. It built that 8-point range the hard way, the honest way, because buyers kept believing in it and kept purchasing new shares for some good reason, right? So that's something you want to look at as a trader, is consistency and volatility and volume and breakout directional string. Next up to bat, we've got Twitter. Tweet this, baby. Boom. Shakalaka. Flawless victory. This guy gapped from 38 all the way up to 40, a 2-point gap. It continued to run. Now it's currently, as of yesterday, right over 41. So a nice big acceleration ramp pattern. Steady uptrend, then it skyrocketed on up, even gapped up. So that's a good volatile chart. Next up, XNET. It also has an acceleration ramp, steady uptrend, hockey stick breakout on high volume. That's all good. It's a good consistent trend. It's not a big loopy up and down chart. I don't like those. I like charts like this that have consistency, especially in the cheaper charts like these. These are a couple of bonus under $20 charts. Speaking of social media, Snap. Like the Addams Family. Ba-ba-da-dum. Da-da-da-da. I love 60s TV, especially Wild Wild West with Robert Conrad. That was my favorite. And I Dream of Jeannie. Those were my two favorite 60s shows. I Dream of Jeannie and Wild Wild West. And Get Smart, too, for that matter. The Cone of Silence. Missed it by that much. Sorry about that, Chief. Anyway, let's take a look at what we got here for you in Snap. Boom! Flawless victory. And my favorite singer is Frank Sinatra, of course. I always listen to Sinatra. They always play Sinatra at Bellagio in Vegas. And I always stay, that's the only hotel I stay at when I take my family to Vegas is Bellagio. And they play Frank Sinatra all the time in the poker room, so it's fun. Anyway, Snap. Boom! Flawless. It ran from 10.5 to 13.5. 3 points of range on a $10 stock in a consistent trend. What else do you want? Maybe it'll run to 16, 17. Maybe it chops and drops. Either way, you should be ready for it. Snap. And that's on Twitter sympathy. You know, the institutional guys, wouldn't surprise me to see Facebook runs too, but I don't like Facebook because it costs too much. But Twitter and Snap are fine. Good charts. ETF charts, not as good, but ITB has a nice recent breakout, so that one makes sense because it's one of the few ETF charts that's reaching for the sky. I live here right south of Denver in Colorado Springs, so I live out in the Wild Wild West, and I can say reach for the sky. Anyway, that's what this guy's doing. Not a great chart, it's an okay chart. But for those who trade ETFs, that's one of my two picks. The other one is XHB. That's a superior chart because of the consistency of the uptrend. The directional volatility in this guy ran from 39 all the way up to 41, which isn't a lot, but it's a couple of points. Beats a kick in the head. So starting to work out to new highs. I like the directional bias of this, and what I especially like is the high volume yesterday. It's got a high volume breakout. This is a 2-day chart of that same chart. XHB, so not too shabby. Let's wrap up with a quick look at our 90-day charts for these guys. If time is limited, which it always is, right? Focus on the charts with the best 90 and 15-day charts. This is LL. It looked much better on the 15-day chart than it does on the 90-day chart. I like all the recent green buying candles, but I do light share size because this is a pivot. So that's why you don't want to just limit yourself. I know it takes time, but you're trading against the best and the brightest in Wall Street, and we're out there trying to take money from everybody. So as traders, you got to be equipped with the same knowledge and intel that guys like me have. This looks great on a 15-day chart, but multi-time frame analysis, you pull it up on the 90-day chart, still worth a shot, but not quite as exciting. So we do light share size in LL. Anything that's less than a strong continuous uptrend, like a bounce by definition, I say it's a good idea to consider. I'm very binary, light versus heavy share size. For me, light size might be 10, 20, up to 50 shares. Heavy share size might be 100 to 300 shares. Your mileage might vary. Maybe for you, light share size is 100 shares and heavy is 500. That's fine, whatever it is. Or maybe light's 5 shares and heavy's 50. I don't know, but do have a number of shares ahead of time in mind that you use in conjunction with the strength of the chart pattern. Don't trade all charts the same number of shares. Kind of Chop City earlier, so let's do light share size on PHM. That's definitely heavy share size. Under Armour has a really good consistent uptrend, so it's a better, superior chart. So of the three, UA is the best because it's got the best 90-day chart. And the range on this guy is spectacular. It's amazing. It's humongous. It's epic. It's 14 to 22, so it's 8 freaking points on a $20 stock, a teen price stock. Not too bad. So heavy share size designation on UA. VRX also valiantly trying to break out to new highs in our pharmaceutical sector. VRX, huge run from 15 to 26. Not quite a doubler, but 11-point range. What a run. That's a heavy share size chart. If you could go back in time and trade at heavy share size, it would make sense. We would want to do so on the right side of the chart moving forward. Next up, we've got CTRP. Light share size because it's a bounce after a big drop. It all looks great the last month or so, but it's likely to kind of spook out traders as it reaches prior resistance area. So it's still worth a shot from a momentum trading standpoint, but these are the kind that I trade on light size. At least when I trade, I'm looking for whether I go heavy or light in the trades, and this would be a light designation. They're all worth a shot, but some more so than others. Mattel, light share size. I like the strength of the trend. The volatility is not spectacular. PTCT, light share size. You know, when you compare it with something like this, that's a better chart, and that's a better chart. If I were to just pick two so far, those would be it. The others all worth a shot, but lighter share size. Next up, Momo. I do heavy in this one because of the strength here recently. The whole last month has been spectacular, going from 35 a share up to 52. So it's a 17, 18-point range. Big range, big strength. That merits a heavy share size designation. I was going to wrap up with our main presentation. Fossil, certainly no fossil here. It's got my classic cup pattern breakout with a large green candle at the right side, and it ran nicely from 16 to 28. That's a heavy share size chart. So far the best charts are Fossil, Under Armour, and VRX. You see the truth of the situation? I'm really good at working my ass off to find the best breakout charts. That's what I do for you guys. I work extremely hard to figure out which charts make most sense, and then within that whole group of charts I narrow it down to the field of those that are even better, right? The even stronger charts. Strongest of the bunch. The leaders of the pack. There was a song that had a refrain like that back in the leader of the pack back in the 50s, but anyway. Twitter looks reasonably good. I do a heavy share size on this because it's almost all green candles last month. A few red candles, but most of these are green candles. And price actions ran from 30 to 41. So pretty good strength in Twitter. So heavy share size player in this. I suspect the rest of these will be light share size. XNet, light share size. Snap, bounce, so it's a light share size. Proceed with caution. ITB, choppy light share size. XHB, ditto. So of the bunch, on a 90-day chart, they all look really good on a 15-day chart, but when you take the second level analysis, kind of the 30,000 foot, this is the 15 days close-up, the 30,000 foot view, or the top level, like the Google Map view, before you zoom in with the plus button, is the main decision-making criteria. So of the three, or of the group, the three Fossil, VRX, and UA make for the best breakout candidates. So anyway, that'll wrap us up for SwingScans. Exactly on time. See a few questions. A question from Guillermo about what's the outcome when I get into a trade, day trading, and I get a false breakout. For day trading, you'd have to ask that question in my live trading room. Intraday trades, if I were to look at, say, DHI, you start off with charts that have minimal false breakouts, but if you were to buy, say, 44.7, might have what's called a 20-cent rule. So if something runs, say, 20 cents, you sell half the position and then trail a stop at break even on the rest. And for more on intraday trading, you can join tradingtheopen.com. This is for swing trading questions and coverage. But basically, I like to keep things really tight within 20 cents or so for intraday. See a question from Brian about do I adjust the stop loss amount something less than $1.50? No. Or do I ever increase on something like a $70 stock? It depends on the stock, but in general 2 points is a good decision making criteria for swing trades. So for example, if you buy this guy somewhere over say 22.8 or 23, the maximum initial stop would be say 21.50, maybe 21, a 2 point range. 2 points is enough range to tell you whether or not you're in the money and likely to continue on up in the money in a chart or not. So once it's run 2 points, you may want to sell a little bit and then trail a stop at break even on the rest. Or if you've got more experience, I like to use over 2 points as a place where I will add to or position size or scale into a winning breakout. Because I start everything off really small for low risk. So if I do get a false breakout and it runs down a couple of points, you know, if it's only 50 shares, it's only $100, so it's not a lot. But if I would have done 1,000 shares right out of the gate, a 2 point stop is a lot of money. So I like to start out, I like to play the field. You know, maybe I'm just trading 3, maybe just UA, VRX, and Fossil. And maybe of those, one's a big win, we don't know ahead of time, one's a break even, and one's a stop. That's a good technical exercise too. Let's say of these 3, I don't know offhand what they're going to do, but they look good at the time. Let's say you play Fossil, VRX, and UA. You got 3 charts. One, let's say, is a big win. The other is kind of a break even, and the other is a stop. How do you make money with that configuration? Well, the key is to use a really tight stop on the stop, and of course the break even's a break even. And for the winning trade, you want to position size or add to it as it continues on up. Because you'll often find that as a trader, you got a blend of or a mix. Let me give you a quick coaching overhead here from that I showed to, it's in my trade mastery course, and it applies from a trade management standpoint. As well. You may stop, and this is a good quick bonus topic here for trade management. Of course, this is for day trading. For swing trading, you may want to add a 0 to these numbers. Anyway, initially, one of the things you want to do is graph out visually the size of your stops and the size of your wins. And what you'll find is odds are you got stop losses all over the map and a few winning trades in the mix, but maybe overall you've got more stops than wins, and the stop losses are costing you more. So that causes that downward move in your equity curve of your account where you get small wins and bigger stops, and that's kind of the death spiral of a trader. You don't want to do that. So what you want to do instead is make it look like this. It's a different graph, kind of like one of those eye tests. Which one's clearer, A or B? Well, this is the first one. Notice please the stop losses are all over the place, okay, which is how I used to trade. What I found over the years is it's much smarter to take small stops more often in pursuit of, so what you get is you get a cluster of a lot of trades near break even. You get small wins, small stops, a lot of scratch trades up or down 50, $100, something like that. So you get kind of a bell-shaped curve, but then the goal is to shape that so that you use position sizing to add to the winning trades, and that starts to push your equity curve up higher. So you get a ton of little tiny stops. It's kind of the price of admission, the lottery tickets, the carnival tickets, the ride tickets at the amusement park. Those are little tiny stops you take in pursuit of larger wins. The way to accelerate that potentially, or to make more, what I found was always add to your winning trades, at least incrementally. Let's say you start off a trade with, say, just 100 shares. It runs up a couple of points. Maybe you add 50 shares. It runs up another couple of points. You add another 50 shares. Then it stalls and starts to drop. And you close the whole trade out, bank a profit, and you're done. So that's a quick, somewhere in here, a quick before-after thing. You should graph out the size and magnitude of your paper trading stop losses versus the size and magnitude of your winning trades. A quick hint here, a quick advanced insider's tip. make sure it's human factors engineering design. I've got dual degrees and all the rest of it. I want to make sure that the size of the stop loss that you graph, maybe you're doing this in an Excel spreadsheet, maybe you're doing it old school on a pad, legal pad and paper. Whatever works for you is fine, but don't let the stop loss cost that you graph, and this is a very good way to discipline yourself to take really tight stops, is don't let the cost of your stop loss on the graph be more than the number that you set. And so that way it should be inconceivable that you would take, unless you get a big gap against you or something, but for the other 98% of the time, the maximum size of the stop loss is on the graph, and in the back of your mind you're saying, well, I'm going to have to plot this trade out, so that should, at least in theory, keep you focused on keeping really small stops so that you don't take big stops, because you know you have to mark it down on a blotter somewhere, and if you don't have space for it, unless you draw a big line on the left or something, which you don't want to do, you don't take stops of larger than a big size. And then over time you get to a place where you're taking small stops, small wins in pursuit of a mix where the overall P&L ratio makes sense. So that's a good coaching tip, just to run a little overtime. But I wanted to answer your questions, and so thanks. I got smart questions. Those are the type of things you want to do as a trader. Spend a lot more time on the math and the numbers than simply the chart patterns. The chart patterns are a big piece of it because you need to have directional volatility and intelligent, well-managed charts that are likely to attract the institutional money flow of professional traders and market participants, the institutional guys and hedge fund and prop traders and all that. But beyond that, you need to manage your risk carefully and manage your entries, exits, and stops in a way that makes money for you instead of donates it to the cause of Wall Street. So hopefully that makes sense. You're right, Bill, Devil's Advocate. That was it. That was a really good movie, too. Thank you. I'm a big movie fan. I like to watch exciting action movies. Green Acres. That was kind of whimsical show, too. I like that one. Question from a trader, does IB have interval 15-minute charts? I don't know. I don't use IB charts. I use e-signal charts. I strongly discourage using brokers' charts, any broker's charts. I like using a good professional charting software platform. So the broker's charts are okay, but personally I like using, I've used e-signal, so I don't know the charts. I've never used interactive brokers' charts. I've never used any broker's charts because I use e-signal. But you know, you can use, whether it's Metastock or TradeStation or NinjaTrader is really good too. Use something other than broker's charts for your charts. Hey Mark, thanks. Oh, thanks. Mark F is saying, thank you, great presentation. Thanks, man. I hope to help. It took me so many years to learn all this stuff, kind of the ins and outs and things I wish I knew back then. So kind of give you the advice I would give my younger self if I could go back in time and encourage myself and capture all the lessons learned of all the millions of dollars worth of stock trades I've done, the difference between what works and what doesn't, and the thought process, hopefully keep it simple and focused in a way that makes sense, right? There's no, you will not ever hear me talk about some magic indicator. Like, you got to use the, XYZ indicator, and it gives you a signal that tells you when to buy. You want to focus your energy on volatility, risk management, directional trend strength, and then develop a breakout platform or breakout trading approach based on trading several instruments intelligently as a group. I look at it like a set of trades, like 6 or 8 trades is a set, or whatever number is, maybe up to 15 or 20, as few as 2 or 3. But I've got a group of trades, kind of like planting seeds as a trader. And you may have seen my YouTube videos or stocks and commodities articles or money show presentations on that. But you want to diversify. Number one rule is, when you screw up and you have a bad trade, it's not your fault. It's just random price action in the markets. Make that as inexpensive and experience as you can. Kind of like going on a cheap date. You don't go take someone out to steak and lobster on the first date. That's kind of overkill. You don't want to trade 500 or 1,000 shares out of the gate on a single trades. You want to play the field and make it cost as little as possible and you're wrong. So did that graph help? I hope it does. It's something it's in my Trade Mastery coaching course. And honestly, it's really the kind of thing you need to spend. You have my word on this. Honestly, from one trade or another, you need to spend a lot more time on this kind of stuff than on magic chart patterns. It's the trade management and the math of your trades that makes so much more sense. As a former corporate statistician, I'm a numbers guy. I'm a hardcore numbers guy, and I know that it's the math is a lot more important than the chart patterns alone. they work hand in hand. You got to qualify. It's like hiring an employee that you have to make sure they've got the right skill set and the background and the work ethic and the authenticity and integrity and all the rest of that makes them qualified for the job, but you want to see how they perform in the job. So the chart pattern is kind of like hiring a qualified employee, but the actual on-the-job performance is the P&L and the math of the chart, and that's a lot more important than anything. So the numbers count. So spend more time on this. Professional traders do, and experienced traders do, like I do, and so hopefully that'll help. Spend a lot more time getting to itty-bitty, cost you tiny bit when you're wrong. You scroll back. As a trader, get away from expensive stop losses. I would much rather look at this. For example, here's like, say, a $300 stop loss. I would much rather have 6 $50 stops than one $300 stop. That gives me 6 chances to get it right. And maybe once or twice it'll work. Okay, but if I take big stops, whatever that number is for you, it makes so much more sense in my extensive experience. You have my word on it. It takes a lot more time to learn this than you'd think. It takes a lot. I'd much rather do 6 $50 stops, and more likely I'd get, like, worse might be 4 stops and 2 wins, and then I scale in and make the math and the numbers work out. 6 $50 stops makes more sense than one $300 stop. So give some thought to that. I know I'm running overtime here, but it's Saturday, it's summer. I wanted to give you guys something good to think about this summer, and combine that with really strong charts, and that gives you kind of the best of both worlds. And that's what I cover here for you in SwingScans, is not only the math and the numbers behind the charts, but the strongest charts to start off with. Kind of start off with good, healthy seeds that you're planting in the ground to see if you can grow a few great trades out of them. So thanks, everyone. Well, thanks, Mark. Oh, thanks. Appreciate it, Guillermo. Thanks, Louise. Appreciate it. Let's see. Yeah, that's good. All right, I'm just reading through the comments. A lot of kind words. I appreciate it. I think that'll wrap us up. So thanks, everyone, for being here. I will get the video up to the members area later today, and you know the routine. Until next time, trade with passion, or at least with a lot of intelligence. Trade with itty-bitty stops. Like, hopefully I went in a little more depth today to give you some coverage on that. And make the numbers work out. Make the math work out successfully for you as a trader. Be careful. When in doubt, get out. Be defensive. You put your cash out just long enough to either get burned or make a win, and then pull it right back into your trading account. So your cash goes out, does its thing, good, bad, or indifferent. Win, lose, or stop, win, lose, or draw, and then comes back into your capital trading account. You don't leave the money out there to be ground down. Make sure you're careful out there and you're trading great charts. So thank you very much for being here. It means a lot to me. I appreciate it. Thanks for all of you who have mentioned me positively on social media and told a friend and the rest of it. Let's make it a great summer together. I'll see you guys in our next session. Until next time, take care. Best wishes for all of you, and let's make it a good one. I'd like to give you good, heartfelt, honest, experience-based trading tips and strategies, hopefully going to keep you on the right side of things. So do well. See you guys next time. Take care.